The IIA does an annual survey where we go to our members and try to find out how many benchmarks there are that our members calculate. And the last survey showed there was 3.7 million indexes that everyone administers. But there was one surprising thing in this year's results, and that was ESG was the fastest growing area of any of the categories that we had. Why do you think that is? Raman?
I think to add to that, if you look at the world, the data and analytics which are coming up is also improving. So one of the questions early investors on ESG were posed, and when they were posed, they said that is ESG investing will lead to less performance, whether at the stock level or the portfolio level. The newer information data which is coming out clearly prove that there's a kind of positive correlation between ESG and the stock market performance. Companies which are better rated in terms of ESG characteristic tend to do better in the long run. So that is a comfort zone for people who have been shying away from ESG, and that could be another big reason why investors are taking ESG in a much more serious manner.
Rolf?
Well, I think obviously ESG is growing faster because it's starting out on a much smaller base. So when you look at it on percentage terms, it's obviously going to have this stellar growth. But I think you're seeing changes both from the supply side. So index providers like ourselves are increasing the coverage. The data is improving. The techniques by which we get the data are improving. But then also on the demand side, I think there has been a softening in the notion of companies existing solely for the purpose of maximizing shareholder value. And I think you do see, that this emergence of the millennials who potentially want their investments to do more than just enrich them financially. They want to do something good for the planet. They want to make an impact. And I think so a lot of what we're seeing in ESG is also much more tailoring of the particular outcome to a particular sentiment. So I think there's also just a lot more diversity in the types of outcomes now that can be created when you start to apply ESG considerations to indexes.
There's a lot of work being done in the ESG space. I know all your firms do a lot of research into some of the newer things and new ways to look at ESG. What are some of those things you're working on? What do you think the next generation of ESG looks like? Chris?
So ESG so far has been primarily an institutional theme. I think that the next step is that it's just going to broaden and become more and more mainstream, which means that people have to understand it better. They have to understand the difference between investing along with your values and screening out businesses that, according to your values, you don't want to invest in, and the concept of ESG, which is really meant to be sort of a risk mitigation measure. It's using non-financial factors, things like diversity, things like scarce resource management, and looking at their impact on different companies and businesses. So I think there's education that needs to happen in the ESG space for it to really broaden out. In the meantime, what we're seeing is clients who are interested in doing sort of optimization. So basically, they're going to end up with an index that looks just like our flagship indices, like the US Ag Index or like the US Corporate Index, but tilting to a higher ESG rating while having those same risk characteristics.
Great. Raman?
I think the biggest trend that we have seen is an integrated view on ESG. So historically, people talked about screening out stocks for maybe specific beliefs and values. Slowly they moved away from that concept into a more of an integrated approach. An integrated approach is that can I take and improve the profile of my cap-weighted benchmark, enhance its profile on the ESG characteristic, and making sure that they're not taking too much of tracking or risk around that thing. That's on the pure cap-weighted benchmark. But also with the climate change risk coming up, there's a big trend towards more environmental focus indexes. We have seen low carbon tracking indexes where people try to minimize the carbon exposure. But also they're also thinking about, can I take those indices and take it to the next level? What are the operational risks and product risks evolved due to climate change? So that's something which we have seen on the equity side. But you can always apply that to other asset classes. We already have fixed income, ESG indexes. There can be private equities space where the private equity can be also impacted by ESG characteristic. So people are still thinking about, can I translate the ideas of ESG in equity space, in public market, and put them in private real assets or in private equity space?
Rolf?
So I think what's really driving a lot of what we're seeing in the evolution of ESG is leveraging the technology that we use to achieve certain investment outcomes and applying that to ESG. The example I'm thinking of is we have a very general framework for providing factor exposure to a portfolio or tilting a portfolio. And so we can use that same sort of technology with ESG. If you think about, for example, a value score that you might assign to a list of companies, some companies have a higher score than others, and you can tilt towards those with a higher value score. You can do the same thing with ES and G type scores. So an example on that, on the environmental side, would be low carbon. So potentially now you can leverage the same sort of technology that you would have used to increase your value exposure to also then decrease your carbon exposure. So it's a real general framework. It just makes it easier for us not only to implement this in various indexes, but it's also easier to explain to the end investor. And I think sometimes it's what's really important. It's not the technology itself and how it achieves the outcome. It's our ability to really explain it in a way that investors can understand.
One of the things in the ESG space is, we're probably going to see a lot more growth in the number of benchmarks and indexes that come out because investor preferences are different in that. Because, what you think or what I think we may not agree on what is a good governance issue, for example, or just culturally or by country we may look at low carbon differently. Raman, how should we think about that, and where do you think this is all headed?
I think broadly, if you look at the market, there are three different categories of investors they're looking at. So although there are so many indexes we can be created, but you can really bucket them into three different ideologies. One is value focus or belief focus indexes, ESG indexes, where people are saying that I don't want to include certain set of companies based upon my values and beliefs. So definitely you can pool those investors together and create benchmark for them. The second big theme is about impact investing. Again, there's a common theme out there saying that, okay, I want to create sustainable development goals of UN and try to improve my impact profile in the benchmark. Again, you can pool those investors together and create benchmark oriented to them. But the biggest trend, again, is on this integrated approach, which will take some of the features of a values-based screen, also impact. And that's where the biggest trend will be. Ultimately, the question which was asked previously was whether ESG impact the stock market or not, or equity performance or not. And research are showing that, yes, it does improve the performance in the long run. And that's the trend that we are seeing. And even if you don't agree on what companies to exclude at the values-based or what companies to include based upon impact, on an integrated approach, I think there'll be commonalities, and that's where the trend will be. And the number of indexes will come down. There can be nuances and regional approaches or global approaches, but ultimately we see that there'll be some commonality in the way that these indexes are constructed for the integrated approach.
Rolf?
Well, I think ESG really introduces two new considerations for index providers. If you think about it, what we've really done to revolutionize this industry is we've, because of economies of scale, we've allowed the whole cost structure of investment management to come down. So that's, by virtue of the fact that we can create a broad market index that, that it appeals to a number of different investors, and we can do that at a relatively low cost, and the product providers benefit from that. So with ESG, you now have this case where there isn't a one-size-fits-all, that potentially every investor might have their own unique preferences that they want to express in their portfolios. So as an index provider, you really have to think about an operating model that can deal more with what's called mass customization. It's not a new concept. I think you saw this in the manufacturing industry, right? How can I create a very customized process but at incredibly low cost? So I don't think we have the answers, but I think clearly as an index provider, we want to continue to think about how we can achieve some sort of economies of scale, even as we're now expected to mass produce these things. The second consideration, I think, is also, we also have always wanted to be perceived as being objective. I think that's very important to us. And increasingly now, as we put our names on some of these ESG preferences, we have to be really careful not to be perceived as, taking a view, whether a social view or an environmental view. I think obviously that gets you into a pretty dangerous realm really fast if someone perceives you as, if you launch an index that expresses some sort of a view as being an implicit endorsement. So I think it's going to come back to our ability to really educate the market and be perceived as being objective, even as we're now creating products that might be expressing very distinct views. Chris?
I think naturally when any new sort of theme like ESG starts to be in demand in the market, people are going to sort of gravitate to prepackaged solutions. And I think that's a lot of what's out there right now. The main ESG ratings providers kind of just have created an ESG evaluation, and going back historically, if companies were going to integrate ESG, they would just take that as it was and start integrating it. But I think now people are getting more sophisticated and they're understanding ESG a lot better, and they're wanting more transparency. They're wanting to see those factors, those underlying factors that are driving that ESG score. And in cases, they're wanting to change them. They're saying that, no, I don't think that that's the correct allocation to that sort of factor. So I think that as ESG grows and evolves, there's going to be more disclosure of those underlying factors, giving people the ability to create more customized versions of the ESG rating that they can then use in an index.